Good afternoon. This is Tim Wegman with BIS Commodities. Taking a look at the review of this past week, the first full week in August. Let's start out and just take a look where we closed for the week. East corn down almost 13 cents at 371 and 3/4. No beans down just shy of 41 cents at 861 and 3/4. August cattle for the week was down $2.42 at 108.25. August hogs going to expiration next week, down 370 on the week at 54.80. Oil continues its weekly slide as well, down 90 cents, trading right around that 67.60 area. And the dollar pushed out to new highs, up around 120 points on the week, right around that 96.20 area. It looks to be to settle somewhere in there. Corn for the week. We'll start out on the week with corn ratings in Monday night coming in just a little bit less than 1% less on the good to excellent ratings. The futures for most of the week was pretty range bound. We were finding support at this 380 level, and the December contract wasn't able to take out that 388 high on the week. Stayed in there. It felt like the trade was just waiting for this week's monthly supply and demand report, and that's really the big news or the driver on the week. And that was going to incorporate the USDA's first stab at yield estimates. They were still able to go back and change some things on the demand side of the balance sheet, but we were curious to see what was going to transpire there as a yield per acre. And the yield came in from them at 178.4. That was more than expected. The average trade guess was right around the 176. So we did see some pressure upon the release of that number, and it was near the top end of the range estimates as far as yield is concerned too. We did see 4 states if the yield, which it will change, but is projecting record yield potential in 4 states across the Corn Belt. Iowa not being one of them. So when we take that number and we plug in last year's supply and demand numbers, which the trade left unchanged, the 2 billion bushel carryout, we plug those numbers into this balance sheet this year. Our carryout number actually didn't come up as much as one would have expected. We did see a carryout of just shy of 1.7 billion bushels. That's up from 1.55. The actual number is 1.684 billion bushels, and that's due to the fact that we did see an increase in demand to offset some of that gain in potential yield, and that was on the feed side as well as export numbers. We did see an increase of 100 million in corn exports. All said and done, a bearish number, but still a tighter stocks number at this point than what we've seen the past 5 years, going back to that 2012-13 time frame. A lot of summer left yet to determine on yield. One thing that we did see is the Command of the Traders report continued to cover their short position. They bought 22,000 contracts of corn. That left them short just shy of 30,000 contracts. They're probably sitting pretty close to neutral, I would imagine, in here, or going into this. Actually, they probably added to this report, after the release today. We're probably going to see some shorts come back in the market. What to expect moving forward? You still have a very large demand base out here. You're certainly not hurting demand. You look at the world numbers, even though they were, the carryout number was up. There's still plenty of demand there that should be supportive to this market. Moving forward, though, we're just going to guess what the yield is. Last year we didn't believe the number. This year there's going to be skeptics of the number as well. A little bit more inconsistencies in the growing season compared to last year. We'll get penciled out in weeks to come, but I think the 380 area is still going to be an important area in weeks to come to try and push and get above those levels again. Taking a look at Soybeans, we started the week out with crop ratings dropping 3% in the good to excellent ratings. That was more than what the trade was expecting. And we did see a nice boost on it on that following Monday night's release of those numbers. And beans were more or less holding the range this week as well, awaiting the numbers that were released here today. And unfortunately for producers, soybean producers, it was an ugly number. The trade came in with a yield estimate up at 51.6. That was higher than the average guesstimate at 49.7. And higher than last year's yield estimate at 49.1. So that weighed on things immensely. We did see him offset it as well on the demand side as far as exports and crush, but that is a big number out there, and that balloon, that carry-out number, clear out to 785 million, which is the highest number going back to 1989 that I've seen, and I didn't look beyond that at this point. If I back up and take a look at this current year's ending stocks number, we did see the USDA cut that 30 million. That's basically due to crush. So we plugged that number in there. Plenty of beans. 785 is a big number to absorb. A lot of things moving forward, but when you take a look at the technicals here, one would think we're going to go back down and test that 835 low in the November contract at some point here in days, if not a week to come. So when we take a look at what the Commitment of Traders report showed us this afternoon, that the funds covered a little bit of their shorts, only about 2,000 contracts. They were short around 56,000 contracts. They certainly added to that today upon the release of this number. And things to look forward in weeks to come is estimating yield at this point. So August weather will be highly anticipated, as it usually makes or breaks the bean yield. Obviously, crop ratings are sitting at a higher level in the good to excellent category as compared to last year at this time, if that means anything. Let's continue to watch those ratings moving forward. They continue to deteriorate. Maybe you see the potential of that yield number coming down. Certainly, though, any news story and or tweet or something new along the lines of the U.S.-China relations and concerning tariffs can move this bean market significantly, either for or against us. But with that big a number there, it suggests, if realized, lower prices are on the horizon. Taking a look at cattle futures, we're weaker all week. Every day we're down this week in the front end of the August contract, following last Friday's big hard up move on the positive cash out there. Cash trading up to 114 last week, up $2 or $3 last week. Looks as if this week is just going to be the exact opposite. Hearing some cash in the south around 111. Down $2-3 overall as a whole this week, and with the futures down roughly accordingly, about $2.50 in the front end of this contract. Boxes, ironically, seem to be holding somewhat of a magnet right around that 205, 206 area in the choice cutout. Doesn't seem to want to fall below 200. Can't seem to get a lot more demand above it, but beef demand seems to be the stronger of the meat market, or the strongest of the meat markets right now. As far as next week is concerned, we're going to have to continue to monitor the cash trade, the boxes. We're still wondering if we are getting through the largest numbers moving forward yet. We still probably have to eat up some of those numbers, continue to keep an eye on weights and kill numbers. Taking a look at the hog market, it continues to fall out of bed, making new lows this week in all contracts. The front end of this contract as well, right up through Wednesday, making new lows. Yesterday we were limit up in October hogs, a huge hard reversal. We've seen hogs up, cattle down hard. Might have been a little bit of a spread trade taking in place there. But we did close the October limit up yesterday. The deferred's up there as well. And we've seen a follow through on the open today as well, pushing limit up again today in the first 2-3 minutes. Unfortunately, actually to close lower on the day in the October contract. The reason for the hard move yet to be determined. There was some rumors that maybe the U.S. and Mexico were making some strides as far as the NAFTA talks were concerned, which Mexico being our largest buyer of pork would have been very good, and a good reason for that. Obviously, we didn't see it in the cash market, though. The cash market continues to sell off. It sells off every day. It was down $1 again today, and I think that's why we've seen that October slide back lower here today on the close. So moving forward, as far as the hog market is concerned, we're going to have to continue to keep an eye on cash, which was down $9.80 this week. That will probably give us somewhat of an indication. It feels as the futures have been the leader, and cash is following suit. But maybe the Packers are making a little bit better margin because the cutout was only down $6 on the week, so they are squeezing a little bit better margin out there. If you were to take a look at those prices, or at least that's what that would indicate. But I think from a technical point of view, we got to see last week's low hold in the October. Maybe we can put a bottom here in the futures market. We still expect big numbers out there. We are seeing pretty good demand as far as exports over the last few weeks. So take a look at that from a monthly perspective and when the next report comes out. So if anybody has any questions about these or any of the markets, please feel free to give us a call here at BIS Commodities at 1-800-373-2525.